And welcome into your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial, investment, and retirement future. He is president and founder of McIntire Retirement Services, Chris McIntire. And to start off the program, Chris, you have your financial tip of the week.
Yeah, we sure do. Tip of the week as we're getting ready to close out 2025 is the Roth conversions. This is the time of year most people will do a Roth conversion because they know how much income they've had coming in already into 2025. They know how much they have until we get to December 31st. So we have a lot of strategy time right here to get these things done in the month of November and December. And with the one big beautiful bill, there's some advantages that you can do that, especially if you're 65 to 68 years old. You get an additional $6,000 added to your deductions of income. So husband and wife that are both 65, another $12,000 of deductions before they start paying tax. Very good time of year to do this, Peter. Good opportunity.
Well, that's your tip of the week, ladies and gentlemen, and it fits right in with our larger theme for the week as well, which is proactive planning and tax strategies. When most people think about retirement planning, the focus is on saving and investing, but often overlooked, Chris, are the implications of taxes and some of the most powerful tools that we have available, tax strategies on how to keep more of our money. So we'll be talking about that today, ladies and gentlemen. Taxes do not go away in retirement. They just change form, and you got to know how to navigate taxes in retirement, and that is our topic. So don't go anywhere. Lots of important information coming your way. And of course, we are joined each week by Chris McIntire, who is your resource for this information. And for proactive planners and savers, you have to have a plan put together. And that's why Chris and the team from McIntire Retirement Services do offer on a complimentary courtesy service to put together a plan for you, your game plan for retirement. If you'd like to take advantage and get that put together, just remember, pick up the phone, give a call, 419-332-0532, 419-332-0532. So Chris, taxes do not go away in retirement. Despite often being overlooked, they will be a factor. Is the first several years, or are the first several years of retirement, a lot of kind of figuring out the new dynamic, the new rules to the game, if you will?
It's funny. We've had a lot of these conversations this year, Peter, as clients who are just retiring. Some of them, retired in April, some of them in July, some of them here in October, and our advice is, as we're, discussing with them, they're always concerned about taxes. It's like, look, this year's an anomaly because you worked half of the year. Next year, it's going to look a little bit different because, you're going to have your Social Security, pension if they have one. And then, how much money are we going to pull out of IRAs, Roth IRAs, other investment pieces that they may have to help control that tax situation. And like you said, hey, it takes 18 to 24 months basically to really get used to this new way of having income come in. Most people don't want to pull out any more money than they need to. But when they were working, they were making more money than they spent. So, it is an adjustment, especially psychologically. And, it's been a decent year here for the stock market by and large. We always hit periods of volatility, and that can help unnerve, recent retirees. So, developing that safe strategy can help eliminate some of the emotions as we walk through this, this first 12 to 24 months of retirement.
Big transition there, Chris. I mean, you go from a year where you're fully working, and for most people, W-2 income, the taxes are sort of deducted as you go and taken care of for you, and then you just reconcile it at the end of the year when you file your taxes. But you go from a year of full employment to maybe a half and half year to then a full year of retirement. So just by nature, that's going to be three completely separate, different kind of tax years. And then you, in retirement, have to figure out which sources of income are going to be taxed more or less, and how much to withhold from Social Security or your IRA withdrawal. So a lot of figuring this tax stuff out all over again. And as you mentioned, you all there at McIntire Retirement Services spend a lot of time with your clients, focusing just on that, helping them figure all that out, navigating that, and formulating the game plan for retirement to stay efficient.
Yes, Peter. And, like you said, if you've worked at the same place for 25, 30, 35 years, taxes were just taken out of your check, like you said. And, in retirement, when you're pulling money out of your 401k, IRAs, you have to determine what amount of tax to withhold from it. And, some people, they come in and, they don't know how this works. And, we just fill out paperwork saying, okay, here's an IRA withdrawal of $3,000 a month. Out of that withdrawal, we're going to withhold 10% federal tax, 4% for the state of Ohio, as an example. So, it's sometimes we just think everybody understands all that. And sometimes the clients are very, almost overly anxious over something that's very basic. And, so, we do have to coach them through some of those decisions there and try to keep the emotions in check there, of course.
But it's all about education and understanding. We need to understand our tax brackets and tax system and the progressive nature, and then the limits and thresholds and the different buckets in which we have saved our money, Chris. And many retirees have most of their money in that tax deferred bucket. Probably not a mistake per se, but sort of time to rethink that, where we've got a window of opportunity, right?
Yeah, without question. And, we do watch those tax buckets, as you say. They got the 10% bucket, the 12% bucket, and then the 22% bucket. And, running through all of the, most people don't know what, standard deduction, what any of that means. And they ask, how much tax am I paying on my Social Security benefit versus my IRA withdrawal? It's like, look, that stuff all goes into the same funnel and runs through the algorithm on the, through your tax preparer's website, and, to help determine what is the total amount of tax due. And many people listening to the show here today, if they're working, they're probably overpaying their taxes, and they get a nice refund right after, after they file their taxes. And, we don't like to do that. We want to pay, maybe just a little bit more than what they owe so that they don't have that big refund coming, because you're just simply overpaying the government and not earning any money on that overpayment. So, we want to try to keep that more in line with, let's pay what is owed, not overdoing it.
One of my favorites, Chris, is should I have or should I keep my mortgage for the deduction? And a lot of people not even realizing that most of us don't even get to deduct that because of the standard deduction being so high, right?
Absolutely. Yeah. When in President Trump's first term, they really expanded the standard deduction just to, simplify tax filing with all the itemized things that people had to do. And I think it's more favorable now than what it was when everybody had to do all of those itemizations.
But again, the brackets that we fall into, there are certain thresholds, and if we go much over that 22% bracket, then we get into not only higher taxes, but potentially the IRMA phase, where we're paying more for our Medicare. Certainly, the threshold for where Social Security becomes taxable, much lower than that even. So all of these implications adding up to not being as tax efficient as we could be. Chris, do you feel like we've been taught to save in such a way that sets us up to pay higher taxes in retirement? In other words, like, did the IRS figure this out a long time ago? Tease us with a little bit of an incentive with save on taxes, only to set us up for pay more in taxes later on down the road. Now,
Yeah, I've given this a lot of thought and talk a lot about this in our retirement classes that we do at the local colleges here in the area. And, if we turn the clock back to the mid 1980s and even the 1970s, income tax rates significantly higher than they currently are. So most people will have that paradigm of, boy, put your income into an IRA account so you don't have to pay the taxes on it and lower your tax bill. Okay. Well, that makes a lot of sense when, you're in the 37% tax bracket, for example. In the 38% tax bracket in 1986 was on income at $64,000. In 2025, the 37% tax bracket is over $600,000. So just shows you where income taxes have come down. Yet most people still are adopting that mindset that income tax rates are incredibly high when they are incredibly low. And in the reality, especially for the people in the 10, 12, and the 22% bracket, and then they progress upwards from there. And so most people are still using a 1986 mindset in 2025. That's my analogy.
Well, again, ladies and gentlemen, we are talking with Chris McIntire, president and founder of McIntire Retirement Services, home of your game plan for retirement, the written plan for your lasting financial confidence, addressing income, investments, taxes, healthcare, legacy, a personalized plan with long-term goals and diversified strategies to help you achieve them. If that's what you're looking for, if you'd like to review and examine the fees that you're paying, the risks that you're taking, the taxes that you may be liable for, how your allocation is serving your needs and meeting and matching your risk tolerance, pick up the phone and give a call. McIntire Retirement Services, Chris McIntire, happy to hear from you, answer any questions that they can, as well as, again, the offer, the real value, putting together your game plan for retirement. And it's a no cost courtesy service. So pick up the phone now. Give a call 419 332 0532. 419 332 0532. Chris, we also need to understand our tax allocation. The other type of tax buckets is we've got tax deferred, we've got tax free, we've got taxable. And I know that there's like this old rule of thumb or theory of the modern portfolio theory of diversification, the 60-40 rule or the rule of 100 to figure out how much risk we should have, how much equity, and then how much we should have more conservative in like bonds or fixed income. Is there any similar rule of thumb on our tax diversification, so to speak?
Yeah, there certainly is. And I'm going to clarify in 2025, married filing jointly, 37% brackets at $751,000. So I said 650. It's actually seven.
Pretty
Yeah.
high though.
Yeah. But
Yeah.
back to your question there. So, yeah, you certainly want to diversify in the tax buckets for sure. And, and as an example, my wife and I have a regular brokerage account with several hundred thousands of dollars in it that, yep, it spins off some dividends and interest throughout the year. We have to pay tax on that as we earn it. But the cost basis, the money that we have put into that account was after tax. So let's say we put in $400,000 and today it's worth 600,000. That 400,000 is tax free if we pull out some of that dollars. The other part would be capital gains taxes. Okay? Our IRA accounts, now we're dealing with income taxes. Okay? And I mean IRAs, 401ks, 403bs, 457 plans. Your tax-free bucket is going to be Roth IRAs. Okay. And then also maybe we could probably put municipal bond interest in there for many people. But by and large, the Roth IRAs are the tax free. So, does it make sense to have some money across all three of those buckets, depending on your net worth? But yeah, very often, we run into that, and that's a very common piece, especially if you're under the age of 59 and a half. You don't want to have everything in your IRA accounts where you have to pay a penalty to get access to it. You want to have some money spread across those buckets as well.
And why this is important, Chris, I mean, you can manage income levels each year by pulling from the right mix of assets. You can manage how much ultimately you'll end up paying in taxes each year in retirement by having that diversification of different buckets, different types of money, as you've talked about here in your example personally. But this is going to significantly benefit you to be tax efficient and keep more of your money in retirement.
Yeah, and absolutely. And that's, tax efficient. Not everybody's going to have a tax-free retirement. And, I mean, most of the money is in IRA, 401k type accounts. As we deal with the younger part of the baby boom generation, and I'm a Gen Xer, I'll put that out there. I'm outside the baby boom generation. My wife is inside it. So, but we see them putting more money into the Roth IRA as financial education gets broader, and they understand that, look, tax rates are low right now. Why am I doing the same exact thing that my parents did when tax rates were incredibly high in the late 1970s and the early 1980s? When Ronald Reagan became president in 1980, the top tax rate in the United States, income tax rate was 70%. Today it's 37,
Mm,
So basically have halved our tax rates. And the funny thing is the revenue went up.
yeah.
So if they can, you can tax too much. So a message to those of you in the state of New York, who will see what the cost of socialism is when everything is free.
Uh, timing Roth conversions strategically, then, Chris, and doing it wisely is key. And you are talking about the difference between the mindset of the two generations. I do think that the idea and the concept, the value and benefit of the Roth certainly is catching on. People are better understanding that now, but we don't want to generally move our entire tax deferred balance over all at once. We want to do it planned, strategically, and efficiently. And you help people map that out. Can you describe why that's important and how you help with that?
I sure do. And for those of you looking on the podcast, we have a tax information sheet that tells us, how much income we can have until we go into the next income tax bracket. There's some good CPA tax planners, around the area that help us, with our clients to say, hey, what if Mr. and Mrs. Smith converted $25,000 into a Roth IRA? Are they still within the 12% tax bracket? And the CPA may come back and say, actually, they have another $40,000 that they could pull out and still be in that 12% tax bracket. And I don't know about you, Peter, but that's a pretty favorable tax rate. It goes from
Sure.
12%, the next tax bracket is 22. So, that's a huge increase, a 50% more increase in your tax rate, basically, on going into that next bracket. So we want, like what we say, we want to bump that 22% bracket, not go over it. Just get in that neighborhood,
Ne-
typically.
Never leave any of the 12% bracket unused.
Yeah, yep. And Phil, and obviously you got to have your wiggle room there, but we've done quite a few Roth conversions here, and we'll continue to do them here through the month of late in the season as we go into 2026.
But planning this out strategically, low income years, down markets, like things that on the surface we wouldn't think to be good, they don't sound beneficial, can be beneficial if we are planning things out ahead of time, have the knowledge and have strategized on how to take advantage of those things, Chris.
Yeah, without a doubt, like for example, we have a company here called Church and Dwight that is local here, and they make Arm& Hammer baking soda for those of you that don't aren't familiar with them. And their stock is down pretty significantly this year. So we've reached out to a number of those clients and said, hey, you still have some of this stock. Why don't we take it now that it's at a lower price? Let's slide some of it over into your Roth IRA, and then hopefully it recovers. And but you've taken 100 shares of stock at a 20% lower price, moved them into a Roth IRA, and if they grow by 20% over some period of time, it basically covers the tax bill, and now it's tax free when we sell it. So, yeah, just a good example there. Yep.
Once again, talking with Chris McIntire. If you've got any questions, if you want to map out your finances as well as overlay that with being strategic from a tax efficiency standpoint so that you get to keep as much of your money as possible into and throughout retirement. That is what the game plan for retirement is all about. Your game plan starts by calling Chris McIntire and McIntire Retirement Services, 419-332-0532, 419-332-0532. Chris, many successful investors do not have all of their money in those retirement accounts. So while the Roth conversions and Roth contributions and strategies certainly a very valuable tax strategy, it certainly also does not encompass the entirety. So in those non-qualified accounts, meaning non-retirement accounts, meaning just an investment account where we've put money that we've already paid tax on once. There are some tax strategies that go along with that as well. Several things, in fact, that we've got on the list. One being harvesting gains and losses. Can you talk to us about when it's time to harvest those gains and how to pay less in taxes on them?
Sure, I'll give you an example what I did personally in the month of April when the stock market went down significantly there as the tariffs and all that came out. Liberation Day, we called that. And I have some money outside of the IRA accounts, and I had some stocks and mutual funds and exchange traded funds that were down in value. So I sold them, some of them, okay, and took a loss. And now I have that loss on the books. I have since repurchased most of those same investments as the market came back up. I only had to wait 31 days before I could rebuy them. Now I got, let's say, a $30,000 loss. I still own the investments that have gone up in value. When I sell them, I have a $30,000 loss to offset a $30,000 gain at some point in the future. So that's what we mean by tax loss harvesting. And I'll use Church and Dwight stock as an example. It's down roughly, depending on the day, somewhere about 20% year to date. So if it was $100 a share and today it's $80 a share, and you paid 100 for it, and today it's 80, if you sold it, you'd have a 20% loss. Okay. And if it was outside of your IRA account, that's $20,000 of loss that you have, and you rebuy the stock 31 days later from now, okay, and it grows from, let's say, 80 back to 100, okay? Now you've got a capital gain that if you sold that stock in the future, it would also you'd be offset by the loss that you harvested in the fall of this year. So I know that can be confusing. It's a little more visual when we show folks on a dry erase board than on the radio show here, but paying attention to what your investments are doing and thinking, all right, the stock market is down, instead of wallowing, staring at CNBC, what does that mean for you in particular? What are the opportunities here? Is it a Roth conversion of some IRA dollars? Is it looking at the non-IRA dollars and saying, hey, I might, does it make sense to sell some of these, buy something different, or buy the same thing in 31 days and avoid what we call a wash sale?
Chris, additionally, a lot of people are surprised by the taxes that are created when they're trading. And access to the stock market has been really commoditized and democratized. Almost anyone can have access on any number of platforms or apps to investing, to the stock market, and to trading. But not everyone has the experience and knows and understands, like you do, the implications of that access and the taxes that may result. So a lot of people trading in those investment accounts and using certain types of investments, mutual funds versus ETFs, that may be less tax efficient. Can you talk to us about, again, in those non-retirement accounts, why we need to sort of beware and be aware of the tax implications of trading and of using the wrong type of funds?
Yeah, so an example is, Nvidia's had another good year this year, and so if you're buying and selling a lot of things outside of your IRA accounts, you're spinning off capital gains taxes. So, and if you're not spending the money, we call that passive income. So you look at your 1099 and you're like, well, God, I got, $20,000 of interest this year and $20,000 of dividends. I never spend any of that money. Well, you might want to look for an alternative strategy that can, make you more tax efficient and mitigate some of those taxes. You can't get rid of all of them, obviously. If you got money in a CD, you're going to get a 1099 on that interest. If you had money in a basic 3-year fixed annuity earning 5%, that's tax deferred. That would be an example, where, making sure you're using tax efficient investment vehicles that can help you mitigate and mitigate taxes on money you're not using.
Again, knowledge and experience, very important in your final results, ladies and gentlemen. So it is about the information and education there at McIntire Retirement Services as well, helping you navigate the minutia of the financial world that can significantly impact your results. And it's not what you make, it's what you keep. Profits are fantastic, but paying unnecessary taxes on them, not so fantastic. And Chris can help you navigate those and better understand. So if this is something that you strive for in your long-term planning, not only the growth and the income, not only the risk management, but also being tax efficient, that's why we're talking about this important topic today, is planning proactively with tax strategies. If you've got got questions, give McIntire Retirement Services a call. 419-332-0532. 419-332-0532. Chris, I hear the comment a lot. Well, I don't get this from my advisor. And in fact, when I ask a tax question, they say that's not their area. And I get it that financial advising and preparing taxes, the work of a CPA doing bookkeeping and payroll, the work of accountants, that is a completely different field and license. But my take on that is when making financial recommendations, shouldn't you also understand and inform people of the potential tax consequences down the road?
Yeah, good point you bring up there, Peter. A lot of folks are naive when it comes to the tax implications of things they do. We do 401k rollovers every day, and it's shocking how many people don't understand that that's not a taxable event. So sometimes we have to back up, and we assume that everybody knows that, but they do not. And people will say, well, boy, if I do a rollover, I got to get that money in there within 60 days. I said, not if you do a direct rollover because the check is made out to the next company. You can transfer an IRA to another IRA. We're all the time moving dollars, obviously, and trying to guide people through the tax implications, if any, of the specific recommendations we're making. We got to do a little hand holding there to make sure that they're educated and that and don't get anxious. And moving assets and things like what we do is you and I talk about it like it's nothing, but we literally deal with people's life savings. They spent 30, 40 years creating this nest egg, and we just work with numbers all the time. We have to remember that, look, there's a lot of emotion tied to this. There are inheritances that we deal with, that inherited IRAs or inherited stocks. What are the tax implications here? What are the distributions that have to come out of these? And people sometimes want to treat inherited money a lot different than their own money because it's a connection to a mom, dad, grandma, grandfather, that sort of thing.
And Chris, as we are closing out the program here, for the sake of time, a couple last but important points here. Don't be surprised by RMDs. Understand them and manage them. And if you are charitably inclined, one of the best opportunities in the tax code is to use the RMDs in your IRA in that manner. Can you talk about these tax strategies?
It is RMD season, just like it's coming up on the holiday season here, Peter. So a big part of our practice is helping people make sure that they're taking the required minimum distribution RMDs out of them, to help them mitigate some of the taxes on those IRA, 401k IRA distributions. Is they can have money be paid directly to a charity in what's called a qualified charitable distribution, or a QCD. Sometimes you hear it that way. So, example, I'm 73 years old. I got a letter from my IRA company that says I have to take out $10,000 by the end of the year to satisfy the required minimum distribution on my IRA account. I could pay all 10,000 of that directly to one charity or more than one, okay? Or I could take 5,000 of it myself and maybe pay the other half to one charity or several other ones. That helps you satisfy the required minimum distribution. It is not taxable to you, nor is it taxable to the qualified charity. And your grandchildren are not qualified charities. Schools, churches are the most common, the Humane Society, that sort of thing. Big time of year, a lot of that is going on right now. And Ross and Robin and Heidi at the office really are looking and making sure that all of our clients have satisfied those RMDs.
Well, planning proactively for taxes is about more than just saving a few dollars. It can make a significant difference over your lifetime and the tax bill that you will pay and how much money you get to keep. It's about maximizing efficiency for your retirement and your income over decades. And that's why you need to have a proactive, forward-looking, experienced, qualified planner on your team. And that's exactly what Chris McIntire does for his clients there at McIntire Retirement Services. If you would like to get your game plan for retirement put together, pick up the phone, give a call, 419-332-0532, 419-332-0532. 0532 419 332 0532, or visit online at McIntireRetirementServices.com. Lots of fantastic resources available there. And Chris, we always appreciate the time and the insight and information you provide, the strategies that you discuss here on Your Game Plan for Retirement. Thank you.
Hey, my pleasure, Peter. Good to be with everybody. God bless America. Be safe.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.